Joining me now as we wrap up the day's markets action is Cobus Potgieter from Southern Cross Capital. Thank you so much for your time, Cobus. Of course, one of the big data points that investors are digesting right now is the non-farm payrolls print that came out on Friday for November. And I'm wondering what you took out of that, because they did tick up more than what analysts had anticipated. And usually that's considered bad news, because it would mean that the Fed stays with its higher for longer stance on interest rates. But also it does signal that U.S. economy is still quite healthy, so maybe a soft landing there. What did you take out of it?
It's always, I suppose we were all expecting that, that pullback towards the end of this year at the very least. And I believe a year and a half ago, everybody was forecasting some kind of a recession in the US by now. So that economy has been incredibly robust. And as you rightly point out, we are still in this sort of twilight zone where good news is bad news and bad news is good news from both a fiscal recovery and a monetary outlook perspective. And I guess based on that, given that the number was high, the market was bearish on the cost of capital going forward, and we've seen that in the rand and the yield locally as well as offshore being reflected. But I think the market is now looking forward cautiously to both the CPI and PPI prints in the US, as well, of course, as the FOMC meeting towards the end of the week.
Yeah, all right. Well, talking about bearish, there's a trend in China of deflation that we are seeing there. Of course, we did get the consumer price index for November, with that declining at its fastest pace in 3 years. Is this just another signal of the struggles that China is facing, and a struggle to kind of get back to its normal growth landscape?
Yes, absolutely. And I think that's what you'll find. I mean, all things considered, given the amount of rand hedge in the JSE, we would have expected the JSE to perform much better today. But because of, both what's happening in China and, of course, the Anglos update. So Anglos in particular, that's been weak, but the resis overall have also been weak off the back of the Chinese numbers. At the very least, in a deflationary environment, you've got a lot of headroom to bring through accommodative fiscal and monetary stimulus. The market has been somewhat disappointed by what we've seen coming out of China, but they've got a lot of room to do this and manage, of course, the deflation of their local banks' balance sheets as cautiously as possible. Also, that's the big sort of hot potato that they're playing with. Having low rates, but sitting with this debt bubble situation. It is a bit of a catch-22, but that's ultimately the sentiment. But I think the market is sort of starting to take the view that it's bottoming out in China, and that trend should start to reverse.
All right. Well, let's get on to some of the companies that had news out, or interesting things coming out of the JSE today. Italtal coming out with a 5-month sales update, and really we know the headwinds that the industry has been facing. They said that their system-wide retail turnover declined 2.9%. Of course, these are not numbers that are surprising. Is this a classic example of that you cannot outrun a shaky macroeconomy?
Absolutely. And this is such a well-managed business, owner-managed, excellent management team with a history of delivering, and frankly, this is a very weak update, and it was one of the most top performing shares on the exchange today, the third best performing share on the exchange. So the market clearly expected far worse than what Italtal is delivering, but ultimately, if you're the best player in a weak market, yes, there are gains to be made on a relative basis, but ultimately you can't get away from the macroeconomic environment. And I think the high cost of interest, therefore bond financing slowing down, has really put a hurt on CTM, their main consumer brand in that business, and we know the consumer is under pressure, and that's coming through in the numbers. But ultimately, still a well-rated team, great business, and seems to do well through the cycle, but ultimately it is exposed to these cyclical headwinds.
Yeah, pretty interesting that you talk about a well-rated team and obviously it being the best player in a weak market, because as much as that was a weak update, we have seen investors acting quite positively, as we did see a climb in that share price of over 4%. So maybe investors thinking, you know what, let's just plow into a counter that has been beaten quite badly, but still a good company. Let's go to a polarizing stock. Some say that it's good, some say that it's too far gone. Pick and Pay. They didn't come out with anything, but I just saw that one of the investors, FMR LLC, actually increased its stake in Pick and Pay. But it was quite interesting to look at that share price, because at some point after that announcement, the share was down about 4%. And I'm wondering if this is a tug of war between investors that still see upside in that business and maybe a bottoming out of the weakness, and maybe investors that think, you know what, it's already lost the race in that food retail sector.
I loved your segue into that. It didn't say what we were both thinking in terms of well-rated management teams, or the inverse of that. FMR LLC is the formal name for Fidelity Investments,
Okay.
the enormous US financial services group. That could mean a lot of things. In all likelihood, it means that that Fidelity managed funds are acquiring. So that's very interesting, you know. And I know a lot of guys are dumping these shares, so local guys in particular. So ultimately, we are very bearish the stock. We think, as long as the Ackerman family maintain their control over that business, it will not be able to recover. At this stage, it looks like a massive recapitalization is required just to get ahead of the curve, just to get invested. And frankly, as an investor, I wouldn't back the current management team, nor the lack of control for the public shareholders in a recapitalization process. There certainly would be value in something like that, but at the moment, there's certainly no strategic vision. Getting Sean Summers back, all of this, the market has not greeted this warmly. But it is fascinating that somebody at Fidelity, or perhaps a Fidelity client, it's hard to say, because the company also acts in a swap capacity for offshore hedge funds. So it's hard to say who precisely is taking this view, but that's a significant move. I mean, they shot past 6%, given the size of the float of this business and the fact that they have to trigger within a week of moving past 5%. It means that they were a big chunk of the buying over the last week. So so that is a fascinating development, that they're taking this sort of turnaround view on Pick and Pay, but I don't share that view. I think there's more pain in the future.
All right. So let's quickly get to your stock pick for today, Cobus.
So this is one of our favorites, but I noticed I haven't spoken about it in more than a year. So given that they posted an update recently, Reinet, I thought it's time to chat about it again. One of the reasons, well, two reasons to chat about it. They came out with the NAV update, all in line, all very positive. The Penscorp business is pumping. The investments in British American Tobacco obviously doing significantly less well, but they have been slowly divesting out of that to the point where it is only around a quarter of the total net asset value at this stage, being over 90% at some stage a few years ago. Well, probably 10 years ago. I've been in the market for too long. But Penscorp also, there's a rumor that they are looking at buyout issues, and the valuation of the alleged pricing for Penscorp in this negotiated potential buyout is at a looks back of envelope, according to my calculations, at around an additional 6% premium to what Reinet are disclosing in their NAV statements. So I don't think they would accept that. They would be looking for more, but it does demonstrate that there's still additional value creation, and that the wider market likes it. And Reinet itself is trading at around a 33% implied discount, and that's using their own metrics. That hasn't even written up the Penscorp, which is more than half of their value, by this potential buyout premium. So it's just something we like and something we anticipate will continue performing. And of course, Rand hedge, quality underlying assets, all the rest. So we like the basket of assets, and we think Reynolds is a very nice, cheap entry point into those.
All right. Well, thank you so much for your time and for your insights on what has been driving the markets today, Cobus. Appreciated. That was Cobus Potgieter from Southern Cross Capital.